I'm going to share my screen right now. It's 4:04. This is Boroughs and Burbs, episode 54, Bracing for an Economic Hurricane. When I heard that Jamie Dimon said that on stage yesterday, and apparently it seemed to cause some people some anxiety because immediately JPMorganChase stock dropped 2%. Down 18% for the year. But I can't believe anybody was surprised to hear him say we're bracing for an economic hurricane. So I thought I would begin by asking two experts, Stephen Lascher of Wells Fargo and David Perry, formerly of Wells Fargo, but now with US Bank, to help us understand the perspective of the real estate business from the perspective of the mortgage business. So welcome, Stephen Lascher.
Thank you. Thanks for having me. I appreciate it. I'm excited to be here and participate in the discussion with you both and the group that's out there.
I'm very excited to have you because usually it's an echo chamber where Roberto and I and a whole bunch of other real estate agents talk about how optimistic we are about the real estate market and how prices are going up. And things are going to be just fine in the New York metropolitan area. And occasionally we'll get somebody on the phone on the show from Vero Beach, and they say things are fine, and Montana, and they say they're hitting record prices. So it's probably about time that we ask you mortgage guys whether things are still in fact fine.
You know, it's interesting. It's hard to go up against Jamie Dimon, considering he's the CEO of one of the most successful banks in the world and has had a stellar career, and candidly lives around the corner from me out this window on the Upper East Side of New York. So he's close enough to come and find me if he's at his home office. But I think the last 2 weeks have told a different story from what we've experienced over the first quarter of 2022. I think we came into the year really an overheated but robust economy. We were very busy, and one of the telltale signs for us is simply, what does pre-approval activity look like? What consumers are calling us and reaching out to our team here in New York to obtain a pre-approval because they're searching for a property. And that activity had been significant. I think, it was maybe off 12 to 15% Q1 22 over Q1 21. But if you look at the numbers from the first quarter of 21, there were some record numbers. I think some of the best transaction numbers we had seen in over a decade. That said, I think, over the last few weeks and with...
Can you see my screen? Because I'm actually showing a chart of what you're talking about. It shows a yellow line of interest rates rising over 5%, but it shows the gray is the amount of transactions. And the transactions were hitting record numbers in March of 2020 and another peak in December, January 2021. And is only recently the amount of volume has dropped way off.
Yes, I'm going to reduce something so I can see the bottom. I couldn't see the years actually when you're doing it. It's interesting. I think what's happening is exactly what the government actually intended, though, right? Bear with me. For some reason, my screen changed. I apologize. I think what's happening is the intended consequence of the government trying to slow the stimulus that they had, pumped into the economy over the last 24 months. I think there was close to $4 trillion of stimulus put into consumers' pockets. I think I read a statistic recently that the money supply increased by 40% in the last 2 years. Money supply being defined as the average daily balances that we see in our checkings and savings accounts. And so, there was continued demand for products, including real estate, right? Somewhat of a limited supply, specifically out of the Manhattan market. And it resulted in significant inflation that is now trying to be corrected by the federal government. And so I'm sidetracking here. I apologize. I think that what we have seen is corrective action that has resulted in the slowdown that was being looked for. And over the course of the last 2 weeks, I think with interest rates increasing by 50% over the last 90 days, and the cost to borrow increasing as such, we've had certain buyers exit the market, but I don't see this as a downward death spiral by any means, actually. I see this as a reset. I think that the Dow is down, the S&P is down close to 20%. The NASDAQ is down close to 30%. I think consumers are looking at their bank accounts, and we've always seen a correlation between the equity markets and the real estate market here in New York specifically, more particularly on the higher end. And so we see a bit of a slowdown there, a little bit of a reset. And I think people are reevaluating, what it is that they're purchasing today.
Well, maybe it's too simple to give you an A/B choice, but is it a crisis of affordability, or is it a crisis of confidence? There's still a lot of liquidity in the market, but so we could say, oh, they have an affordability problem. Stock market is down and rates are up. So we have an affordability problem, or do we have a confidence problem where people have the money, but they're just not willing to pull the trigger?
I think it's a little bit of both. I think it really depends on which segment of the market that you're looking at, right? So I think in that kind of below 2 million, even below 3 million price point, right, in New York, you have consumers that it becomes an affordability issue, right? I mean, the fact is if you were borrowing $1 million at a 3% interest rate 90 days ago, your cost was $2,500 per month on an interest-only basis, right? If that interest rate increased from 3 to 4.5%, which it has during that 90-day period, the cost to borrow increased by $1,250 per month, or up to $3,750 per month per $1 million borrowed. So if you're in that below 2 million price point, I think that has a material impact. Though, what I would say is many of those buyers, many millennial buyers, wage growth has been significant, right? And so while it hasn't necessarily kept up with inflation, some of these young buyers who do seem to believe in real estate as a solid investment, they're coming out of undergraduate making $150,000, $175,000. And so their ability to afford that $1.2 million, $1.4 million, $1.8 million property does still actually exist, right? Because if you're making $15,000 a month or $180,000 per year on an after-tax basis, assuming that 1/3 of your income is being paid to the government, you're still taking home $10,000 a month in after-tax income. If you can borrow $1 million for $3,750 and then have carrying charges on that condo or co-op unit of an additional $1,250 to $1,500, your total monthly expense to buy an apartment that's, let's say, somewhere around $1.25 million and make a 20% down payment is between $5,000 and $6,000. And my gut is you would be able to rent similar, right? So I actually think that you still have, while affordability becomes a concern, I don't think rates have increased so much at this point that it's pushed out, 75% of the buyers. Maybe 25% have potentially dropped off. But I still think there's...
Stephen, at what point do you think that it actually does become a major affordability issue? At what, do we have to hit 6? Because if you look at prior to 2008, like 2006, 2007, interest rates were fairly high, and we still had a really good run of property, and it seemed more of a buyer perspective, or a buyer, it's like coming off of a high. We've come off of, our volume is still quite strong. It's just not what it was last year, which was an incredible record level. Like, we're still on a high, we're just not on that high.
Right. So I think, and so just sorry, ask me this specific question again in terms of what was the question?
At a certain
How
point,
high do they have to go?
Interest rates right now, interest rates have definitely created a bit of a pause in people. And I think a lot of it is the relative perspective that we're losing a little bit of steam in our purchasing power. So people are recalibrating where they are. Not that they're not going to re-engage, and not that they're not still buyers, not that the demand is diminished. And some people have obviously gotten priced out. But at what point does that really become one of the main factors of why the market may slow? Because we've hit 6, we've hit 6.5, we've hit 7.
I mean, in fairness, I don't have that mathematical calculation in my head in terms of evaluating what does inventory look like compared to monthly expenses versus wage growth versus, equity market valuation declines. What I think is that we saw one of the largest real estate booms ever with an average interest rate of 6%, which is 25% higher than we are today. And so if you look at historical mortgage rates, basically, let's say from the year 2000 to 2010, right? You were somewhere around 6.25%. So I think there's a long way to go. I think there's still a lot of opportunity. I think where for me, we see a little bit more of a settling or an affordability concern is actually more in this $3 to $5 million price point, actually. I think that segment of the market is a buyer who may not fit in that true affluent category of 5 million plus, where the variation of monthly payment from $5,000 to $10,000 is somewhat irrelevant if you're making $2, $3, $4, $5 million a year. I think that becomes more of a confidence piece, right? At that higher price point in terms of where are the markets in general. What do I think valuations are going to look like 6 to 12 months from now? Is right now the right opportune time? And is there a need, right? I think in that 3 to 5 million price point, you have a buyer who's putting 20, 25, maybe 30% down. They may be making 7 figures because they live in Manhattan, but as we all know, that's kind of the new middle class in that price point. They may have children in private schools, things of that nature. So, if they're borrowing $3 to $4 million, and their payment has now gone up $5,000 or $6,000 a month, and the cost of living has continued to outpace their wage growth, right? So they may be earning well, but they may be earning 5 to 6% above historical averages, where inflation is at 7 or 8. So they're still net negative. I think that's the pocket for me that I see slowing down more significantly and being an affordability concern. Below 3 million or below 2 million, I think you'll just lose some of those buyers because they can't simply afford it. But I think that there's enough demand, there's enough population growth, there are enough actual human beings in that market looking for a place to live in New York, that I don't see that segment of the market disappearing or diminishing from a value perspective.
But
so significant.
The prices have to stagnate a little.
No.
Without a doubt. Sorry, I should rephrase my last sentence. I definitely believe that we are going to see a correction in price. I think we already have. The question is, how deep is that correction, right? Is there enough demand, and is supply limited enough, regardless of whether interest rates are 4.5%, 6%, or 7%, to have a certain support level that is not significantly lower than where we are today? My gut.
David is joining the call. David, say hi.
Good afternoon, everybody. My apologies for the technological difficulties. I'm very pleased to be here.
Glad to have you with us. So far, we've been talking about the rise in interest rates, and we're starting to see a slowdown in volume. And the question that we're wrestling with is this a problem of confidence in the public, that they're surprised by the rising interest rates, or is it genuine affordability? And one of the things I'm hearing from Stephen and Roberto is that you're seeing a different reaction at different price points in the market. Is that right, Stephen? That the $5 million guy is affected differently than the $2 million guy.
I do. I feel very strongly about that. I think that $5 to $10 million buyer may have made $20-30 million over the last 3 years during COVID. And even if they've lost a significant portion of that wealth over the last 90 days, an interest rate at 4.5% versus 3% is not forcing them to exit the market from an affordability standpoint.
My question for David is, are we seeing a movement toward adjustable rates? That's one of the ways to get my mortgage down, to get my affordability up, is to go after one of those 3.75% adjustable rates. So are you starting to see people shying away from the 5.2 fixed and moving into the adjustable product?
We are. We're taking a significant higher percentage of adjustable rate mortgages. And I think people are looking at it as a transitional step, right? I think many people think the rise in rates aren't necessarily here to stay. And they're looking at it, let me take a 5 or 7 or a 10-year arm out. And, at the end of that time frame, they're thinking rates may come back down and they can simply refinance back into a fixed rate. So we are seeing, with loans of that size, a significant difference in monthly payment. We are seeing a lot of interest, renewed interest in adjustable rate mortgages.
Who are these people who think that the rates are going to come down? Aren't they reading Jamie Dimon? Aren't they reading what Jerome Powell is putting out? Don't they know that we've got like 7 more hikes to go or some crazy number?
Well, I agree. It's not going to be immediate, John, but I think, if they're looking at it over a 5, 7, or 10-year window, I think they're a little less concerned than they might be over the next 18, 24 months. Without getting political, I think they're looking at certain situations and thinking that some of the rate hikes might be based on policy decisions, not based on just the market. So I guess time will tell. But there are people that feel that, rates are going up, and they will be going up for the next year, maybe 2. But then after that, we'll see what happens.
So let's talk about that just from a standpoint of possible predictions. Once we do peak, whatever that might be, 6, 6.5, whatever, what does the backside of that look like? Is it going to be, is it likely that it'll be 3 or 4 years for it to potentially gravitate back to 3? Would we ever get to 3?
I'm sure Steve can comment on this too. I mean, it's very hard to predict that. Will we ever get as low as it was? Probably not. The Fed not buying mortgage-backed securities any longer. Obviously another policy decision is certainly spiking rates now. Will, a change in administration or a change in the composition of the Congress change that policy? Hard to say. But I do think, we are going to see a spike and we're going to see a peak. And then I think you might see a drop back down to more reasonable interest rates. I mean, I've been doing this 33 years and remember the days of 12 and 13 and 14%. Are we going back to that? I would like to think not. But, will 7.5 get back down to 5.5 or 4 3/4 one day? Possibly.
No, I would agree with that. I think that, it's very likely. I mean, my gut candidly is that it's very likely we'll go into some sort of moderate recession late this year or early next year. And if that is the case, I do think that you'll see people retreat into bonds, and mortgage rates are really driven off of the 30-year treasury. They're not necessarily driven off of the Fed funds rate. While the Fed funds rate can drive some of that activity, I do think that if we end up in some sort of moderate recession, people will retreat into bonds as a safe haven. They'll drive up the cost on a 30-year bond, which will bring yields down. And so while maybe, I knew Dave was just using examples, David, excuse me, but maybe we rise up to 6.5, 7, 7.5%. But, could we settle back down in the mid 4s or low 5s? I think that that's very possible. And for all we know, maybe we end up having a very strong 2023, right? If prices reset by 15%, 18%, and rates actually stay where we are today because they've dropped back down, I see that for New Yorkers as a potential buying opportunity.
That's a big reset. That's a big reset you're talking about. COVID, I mean, on average for COVID, we dropped 8 to 10%. So you're talking 10 to 15%. That's a big adjustment.
I want to put a chart on the screen just to remind everybody that Florida, see, is red, overheated. You see Arizona, overheated. Texas, overheated. But if you look at Connecticut and New York, nobody thinks that New York and Connecticut are expensive relative to the rest of the country. So when you talk about a reset, Stephen, are you talking about in the New York metropolitan area?
I think when I'm speaking on this panel, I'm speaking specifically to the New York metropolitan area and the boroughs, right?
Okay.
Yeah, I mean, I think we're very unique compared to the rest of the country, right? I think we live in our own bubble here, and it's a wonderful bubble with which we live. And I think, like any real New Yorker, I'm a huge believer in us. And anyone who asks me about buying real estate in New York, it's very likely I'm going to say to them, I think it's a great investment over the long haul, right? There may be pockets in which we dip, right? But over the long haul, I've been fortunate enough in my 20 years living in Manhattan that any piece of real estate I ever bought at some point was worth more money. And there were some great tax benefits to purchasing real estate too.
So in the last couple of weeks, we talked to the folks at Vero Beach last week, and we said, how'd it go last year? And they said up 20%. And we said, how's it going to be next year? And they said, 7%. And then we asked Jonathan Miller or from Miller Samuels about the New York market. And he said, yeah, we were up 15% last year. And we said, how's it going to be next year? And he said, probably in the 7 to 10% appreciation. So when you say the word correction, the hair on the back of my neck goes up because nobody is talking about a down prices going down in this area. That's the first time I've heard, because nobody has accused the New York market of being overheated, that we're still coming out of COVID. We're still trying, we're the last to come out of the COVID price appreciation.
Listen, I think the last 2 weeks have been a very interesting and confusing time frame. I'd say 2 weeks ago, we had not really seen any slow. We weren't so concerned. I think that the last 2 weeks are a snapshot in time. I think the weather's beautiful. I think people's accounts are down. I think rates are up. I think they're concerned. And so this may just be this small pocket. And why I've said, I don't think this is a downward death spiral by any means. But I do think that the fact is the Fed has stepped in, and as strong as the New York market can be and as resilient as we can be, days on market have increased significantly over the course of the last 30 days or so. Supply, while I think we were at about 8,000 units this time last year, we had dropped to 6. I think we're back up to about 6,500. So our supply has grown a bit. And so, I have to think there's some level of correction. I speak to brokers every day, and there is fear in their eyes and in their minds. I can feel it, right? And so my gut tells me there has to be some sort of modest correction.
What I think is we had the COVID discount, that 8 to 10% evaporated. And we got back to like 2019 levels. We were just starting to see some price appreciation happening at the beginning of this year when the interest rates started to go up. So now I just think we're going to start to see a little bit of pause. And I think the closing prices are still going to continue to have a moderate, they might plateau a little bit, but what's happening is that the pricing has gone up. The pricing will have to settle so that it stays more on a more plateaued level. That's what I believe. But I still think there's so much demand, and we're only really like 85% back in New York. We may not get to 100, but we're going to get to probably 95. And that's a big run of demand over the next couple of years. And once people acclimate to what 5% interest rates mean, 5.5% interest rates mean, they're going to have to allow their life to continue living, and they're going to have to buy or do whatever they're going to do. But I think it'll start. I think it's just kind of like, whoa. And then you got to put your boots. You noticed it snowed outside. Now you got to put your boots on and you got to go.
Listen, I think it's a great perspective. I mean, I think that makes me think a little bit more about, my commentary, how I evaluate it all in general. I actually do think that, once people do kind of become more comfortable again, rates are still very low, and actually there's great investment opportunity too. So, the fact is rental right now is probably a good time to purchase real estate and lock in a long-term low rate, even at 4.5% or 5%, because the rents will yield a profit, and it's a great hedge against inflation if rents continue to go up and you've locked in, a fixed rate mortgage over an extended period of time. So that in itself would lend credence to your argument to say that there are other support levels there, right?
I want to ask about risk, and I know that both of you gentlemen have experience with Wells Fargo. A couple of years ago, Wells Fargo made the decision that Connecticut was a risky market, and their response to that was to say, we don't want to do a greater than 75% loan to value, in that market. So I want to ask, generally speaking, as we move into, as rates increase and to 5, 6, or even higher, affordability is a challenge for a lot of people. According to the graphs I sent out in the email earlier today, you're starting to see the mortgage payment is now rising as a percentage of household income. It's now up at 31% on average nationally, up from mid-20s. So as the risk profile goes up, banks respond. Can either of you talk generally about how banks are going to respond in a rising interest rate environment, lower affordability, and is it going to be harder to get a loan? I mean, I might go out there and say, fine, I'll pay 6%. Once, as you say, as Roberto says, I put my boots on and I accept the fact that, that's the new number. But the banks may not give me the loan. Is that right?
I'll jump in first on this one. First of all, what happened in Connecticut 3-4 years ago, was basically looking at projections on employment. That was the biggest concern. And obviously the state of Connecticut had a lot of employers that were either leaving or not reinvesting. We are seeing in different states now, banks taking a look at some of the states you mentioned, John, Florida, Arizona, Nevada, and we are starting to see, lenders deciding to cut back on their loan to values. Not happening in Connecticut and New York right now, which is a great thing for our local market. But that's one way you kind of mitigate risk. But there's another reaction to that, is that banks aren't booking the amount of loans they were last year either. So it's also extremely very competitive right now. And I still see certain lenders that are actually increasing their loan to values in stronger markets and are making more exceptions in underwriting. So, there's risk on both sides. Yes, you could maybe overlend and be a little bit too aggressive, but you could also be booking no business, and you can't get too conservative in this market either. So, there's a lot of things in play here. The quality of the loans is far different nowadays than it was years ago. Chairman Powell said there's no problem with performance on loans right now. Loans are probably performing the best they have been since I've been in the business, and that's over 30 years. So I think there's a lot of good in terms of where the banks are positioned. And yes, certain markets might be more of a risk than others. Certainly Florida, as you've mentioned, and Arizona and some of the other states where there's been mass migration to those states. But I think there's the counterbalance that you can't get too conservative and not be putting books on your balance sheet, booking loans on your balance sheet. That's a risk as well.
I would agree. I think the credit quality today of the loans that we're originating as a general matter is extremely high. And so, we're less than 1% default rate on portfolio loans. So I think there's less concern about that. And I don't anticipate a pullback for that reason. I think that when the data starts to show in some of these submarkets, more specifically, in my opinion, outside of Manhattan, that have appreciated 30%, 35%, assuming some of the data shows that valuations are decreasing, then I think you could see lenders become a little bit more conservative in terms of how they're approaching evaluating their collateral. maybe that becomes there's 2 appraisals being done versus 1. Maybe it's that loan to values do pull back. But I think as a general matter, credit quality is very strong. We need to feed the machine with business to keep business running. And so I'm confident. I don't see that happening. Where I do see,
love that quote, by the way, need to feed the machine. Roberto and I and the folks on this call, we're doing what we can. We're going to try and feed the machine, Stephen.
We appreciate that, both David
part.
and I. I don't mean to speak for David, but I'm sure he appreciates it too. I do think, though, and I listened to Jamie Dimon's at the Alliance Bernstein conference this week on structured credit. He spoke in addition to, I think, their investor day. And there's been some quotes from, candidly, our CEO in the last week or two about, how will we allocate dollars in a new economy, right? And so while mortgage is a very desirable business, if you have customers that are in other, transacting in other ways with you, they have deposits with you, credit card, auto loans with you. I think there's going to be a continued desire to do business with those customers. But the fact is there's significant regulatory requirements in terms of the dollar of assets we need to keep on our books for every loan that we put out the door to ensure that we are secure and we don't see another kind of credit crisis like we did in 2009. And so the return on equity, the return on that asset, putting those dollars out the door, diminishes with each other dollar that we need to just keep in our vault as an offset. And so I do think, and I don't know if Dave has an opinion on this, that we could see some pullback on the desire to continue to grow the balance sheet for that reason, not because of credit quality concerns.
I saw that in Jamie's remarks yesterday. Go ahead.
I would certainly agree with that. I mean, there's only, so many dollars to go around, and when banks have to increase their reserve requirements, they have to be more careful. Certain banks are going to have more healthy balance sheets than others. And then when you look outside of banks and you look at the mortgage brokers and the mortgage bankers that are borrowing on lines and their spreads are getting squeezed, they're going to be under some pressure as well. So you're definitely going to see some changes in the way lending is done. I think outside of the banking world more so than, the banks' large balance sheets.
Does that go right along with what he said? He said, I kind of want to shed non-operating deposits again, which we can do in size to protect ourselves so that we can serve our clients in bad times. That's the environment we're dealing with. Is that what he's talking about? Non-operating deposits?
Yeah, I mean, they absolutely have to have enough reserve requirements for, dollars that are going out the door in terms of lending. And as Steve's point, it's not just mortgages. There's pressure on student loans and credit cards and other types of debt that are increasing in their balances. So banks have to be able to offset that and have the reserve dollars that are required.
So let's talk a little bit more about affordability. John and I had a conversation a while ago, and it's when it struck me for the first time, and I had my shock moment of, this is really becoming, the affordability is really a problem. This is probably 6 weeks ago when I first contacted Stephen about trying to get him on, but he was so busy, I couldn't. But we had talked about, John had said, look, mortgages used to be 10 years, 15 years. Now they're 30 years. Is there a plausibility that we'd see a 40-year mortgage, a 50-year mortgage, or something that's multi-generational, that's very, very long?
Dave, I'm going to throw that to you. I'm not sure on that one. I'm not sure exactly how to answer that. And while I've got a good 20 plus years in the business, it sounds like you've been around a little longer and maybe have more experience with that type of product.
There was many, many years ago, 40-year mortgages available. And I forget exactly who was offering them, but it was never a popular product. I mean, people look at the amount of extra interest they were paying, and it was just really never accepted as being something that was a product that the customer wanted and that the bank felt comfortable selling. And, would we get to that? I don't know. I think the regulators might not like that product very much.
Right. Okay.
Good point. I don't see the regulators loving it based on the accumulated interest over time and the impact to the consumer in the end. And then I don't see us necessarily loving it because, while, as we said before, it helps you feed the machine, you may be putting buyers into properties they really shouldn't be into. And the fact is, if values decline, you have, less equity being plowed into each payment, right? With longer amortization. And so, our risk is diminished with each payment on an amortizing loan of 30 years. Over 40, I bet you if you start to really run those risk models, there's greater risk.
I'm going to counter that. I'm going to argue, and I'm going to tell you why it may come about. We have 80 million millennials. We have a great deal of millennials entering the market now. They're entering the market where prices are hitting record highs and interest rates are also rising. Something has to give. What I hear you saying is, well, we've got to see a price correction. That's not necessarily true. You've got a lot of other things that would argue against prices coming down. First of all, you don't have enough supply. You have other, it's going to be very expensive and difficult to build new product for the millennials. So if neither of those variables change, interest rates don't come down and prices don't come down, then there's got to be a way to make housing affordable for the 80 million millennials. And bankers are innovative. There was once upon a time when we couldn't imagine packaging them up and selling them to Wall Street. And now, and then that became the norm, not the exception. Well, I see it's possible way to extend the term to 40 years as a way to make the payments more affordable for the millennials. I'm not talking about it's a preferred product for the $8 and $10 million buyer in Palm Beach, but I could see a 40-year product being offered to the 25-year-olds who are already saddled with a good deal of college debt and credit card debt as a way to make, because you've already got regulation that says, what is it? You can't spend more than 32% of your salary on your mortgage. Well, it's the only way to get it done is to either go into a variable product or extend the term. Am I right?
The counter I would say to that, here's the interesting stats that I pulled this morning. We look at the state of Connecticut and New York City, and really we're kind of talking about Fairfield County and the metro New York market. But in the month of April, appreciation in Fairfield County was 9.4% over between April and May. So still the numbers are skyrocketing. In New Haven County, you just move over, it's 3.6%. And if you get up to Litchfield County, it was actually negative 6% appreciation. So we're already seeing certain markets where it's starting to dip. And I think what's going to happen is, the affluent who've made a ton of money, like Steve said, they're still out there buying. They're repositioning their portfolios, and they've lost a little bit of their equity. So what? I'll reinvest in real estate. When you get to Main Street America, where they have to sell their homes in order to buy something else, and right now they're just not getting what they need to get, and they can't move up. Eventually, that's going to have a trickle down where you don't have your move-up buyers who are then taking the homes off the affluent so they could buy something else. There's only so much money out there, I think, where we're going to continue to see prices go up. I don't think the price appreciation is sustainable. I think it could plateau quickly, and I do think we're going to see certain markets where we're already seeing it in certain markets in Connecticut where the price and demand is starting to go down. So I don't know if we're going to continue to see the appreciation we've seen.
Hi, guys. Can I ask a question? Hello, I'm Dejanay. I am in the Riverdale office, and I work with what I would like to call the bread and butter sellers and buyers. So I put in the chat, could it be the issue can also be that the houses are overpriced right now? Like I've been hearing a lot of sellers say, well, I want $1 million for my house. But they're at the tail end of what happened during, 2020 and 21. Now things are slowing down. Now people already bought up and they use their Bitcoin money and their investment money, and they're still holding on to this $1 million dream. So could that also be a factor besides the interest rates? Because this is not the highest that we've ever seen. So maybe that's not the issue.
So you're saying that your buyers feel that this area is overpriced, unsustainable, and those prices have to come down.
Yes. I have someone that was pre-approved for $975, and we saw a property around that price, and he was like, I think it's overpriced. I like it, but I think it's overpriced. And then I have a buyer that thinks that, you know, a developer is going to buy my property, so I only want to market to them, and I only want to list for $1 million. Someone else said the same thing, and her property's been sitting on Zillow for over 200 days because it's listed at $999, $999. So maybe that can also be an issue in conjunction with the interest rates being high.
So what do you think, Stephen, David? Are you seeing that your people who are coming to you for mortgages are less sensitive to the interest rate of the mortgage and have been waiting because of the pricing, primarily because of the pricing? A perception that
I would agree with that.
Too high.
Yeah, I would agree with that. I mean, you know, in the markets we're dealing with, I think people are getting anecdotal advice from friends and family, you know, wait until the bubble bursts and then comes back down. And I'm not sure it's a bubble. I do think we're going to see some plateauing. But I think they're listening to people out there thinking these prices are unsustainable. And the interest rate conversation hasn't been as prevalent, John. We haven't really seen people say, you know, they may not be happy that they've gone up as quickly and as much as they have, but we haven't seen people say, I'm not going to buy because of the rates. I think it's the sticker shock on the house more than the rates. That's been my experience.
I would agree in general. I think a larger percentage of the time, it's more about the market and valuation and where they are over, you know, affordability due to interest rate. I mean, I think they work in tandem to a certain extent. You know, I mean, John, I love your optimism. I mean, I love it. And I think that, you know, both you and Roberto have provided some really interesting context, and I think thoughtful context. You have a lot of data, and it's making me think about things a little bit differently. Though I think that the economy is a bit overheated, and we have to see some sort of correction. I mean, we're coming off of 2% interest rates. I mean, you know, I look in the Hamptons, right? I don't want to say it was easy, but if you worked in the hedge fund world or the private equity world, right, and you're in that market, and sorry to sidetrack away from what did you describe as bread and butter? I like that. You know, some of these people made just enormous sums of money, and it was actually relatively inexpensive to buy a $3, $4, $5 million home in the Hamptons when you could borrow the money for $60,000, $80,000 a year plus your expenses. So, you know, for $110,000, $120,000 a year, you could buy a beautiful home that, based on the market at the moment with rental prices in the Hamptons, you could rent for $250,000. Right.
So let me ask you, did you see, you know, there were buyers that would typically buy a $20 million house, and they were typically cash buyers. They just pay for it. But I saw over the last several years, a lot of those people were like, I'm going to finance 15 million because it's so cheap. And because I can make a heck of a lot more money with that money somewhere else. Did you see a lot of that yourself?
I saw a ton of it, but we actually, so what we saw was there's, you know, that's the rich get richer kind of statement, right? I mean, there's some, while I'm not a CPA and I do not provide tax advice, there's some really interesting tax strategies that the uber affluent can capitalize on. And so what we've seen are a number of buyers actually stepping in, closing in cash because they have the ability to, right? It makes them a more compelling buyer. And then extracting that equity, let's say 90 days later, and borrowing 50% of the purchase price on a $20 million acquisition. And there are certain tax strategies that allow them to actually deduct 100% of the interest expense on that $10 million mortgage.
But let me ask you that. Pulling that money out typically was a higher interest rate. Do you allow them to do that within a certain, say, if you do it within 45 days, we'll give you the same rate?
So I think every lender has different requirements, and I don't know what they're doing at US Bank today. We happen to have what's called a cash recoup program, where if you close in cash and we can document that you've used your own funds or funds that you've borrowed from yourself, let's say, secured by equities that maybe you didn't want to sell, as long as you apply to us within 90 days of closing in cash, we will deem it a recoup transaction. We will provide the exact same terms we would have as a purchase.
Okay. And if that time were to expire, what was the differential of, say, so it's like qualifies as a refi?
You know, with that credit profile buyer, you know, so there are two variables. There's pricing, right? So the interest rate would maybe have been 0.25% higher as a cash out refinance versus an acquisition loan. But typically on a cash out transaction, we're providing less leverage because it's deemed a higher risk transaction. But with that type of affluent buyer, the ability to close in cash, I don't think we're really, you know, if policy on a cash out was 60%, but the borrower wanted 70 and our purchase policy was 70, we'd probably still lend to 70 to that credit profile.
It's an incredible thing to be rich, you know? It's like the athletes. They wear the best stuff, but they don't pay for it. It's all given to them.
Totally. Well, it's another interesting thing is, you know, I don't know about, you know, Dave's at US Bank, but we've all seen a significant drop off in our refinance business. I mean, you know, substantial, you know, more than 2/3 of the business has evaporated refinance, which by the way, for the brokerage community in a way is a good thing because we're more eager for your purchase business. So we're being more competitive in that way. And we have excess capacity. So in terms of turning commitment letters around and executing more efficiently, that does create, you know, good opportunity in a purchase market. But it's interesting. The refinances that we're doing today, or at least that I'm personally working on, happen to be for those uber affluent who have looked and said, why am I sitting on a $10 million, $20 million home that, to John's disagreement, may be worth 17 million, you know what I mean? Or 8 million, you know, 3 to 6 months from now, let's pull out the equity and lock in even at 4.5%, because I see a correction and I know there'll be an opportunity for me to invest that capital and lock in at these low rates. So that's actually where we see most of, or at least personally, my refinance activity. It's the uber affluent pulling the equity out.
Wow.
As if
we're seeing the same thing.
Go ahead.
I was going to say, we're seeing the same thing. I mean, people that are, you know, they're doing it strategically. The day of, you know, I'm going to save 1.5% or 1% or even 0.75% on a loan based on historical rates is gone. I mean, our numbers, we reviewed them this morning, and we're well over 80% of our transactions now are purchase. And to Steve's point, the refinances are those that are more strategic and thinking they can use, you know, they could borrow the money and make better returns on it by still borrowing relatively cheaply and reinvesting the money back in the market.
80% of it was 80% of it. You're saying is purchase now. What was it, say, 2 years ago?
Oh God, there was times where we were 60-65% was refinance.
Wow.
Yeah.
It's gone from, you know, 60-65% down to 20 or even 15%. It's primarily purchase money.
Which is why I think, sorry.
And related to that, home equity lines of credit, is that also in the same boat where it's just another mechanism where people can extract equity out of their houses, either to improve the house or to redeploy it elsewhere? Are you also seeing HELOC activity alongside refinance activity?
We are. We do a lot of HELOCs, and you know, it's smart as an insurance policy, right? Somebody wants a line of credit set up in case they need the money. But then, yes, John, they're pulling it out. They're doing a lot of home repair, and they're also, you know, perhaps taking the equity out and buying something else, another piece of real estate. So yeah, the home equity markets are pretty active.
I can tell you that in, say, a typical town in like New Canaan, but it's probably happening all across America. If you see too little, you see prices have gone up and too little inventory, and you've decided that the family's gotten larger and you want to trade up and you want to move across town, and there's no inventory and there's nothing to buy, and you can borrow money at 5% on your appreciated home, that people are talking about adding that, adding on to their home, improving their home, because there's nothing to buy a lot of times. So yeah, I can see how the HELOC market might be growing as a result of a lack of inventory, a lack of choices out there.
Yeah, absolutely. Once they get over the sticker shock of what the repairs or renovations are going to cost them.
Right.
But once they get through that, yeah, they are borrowing on, and they have on unprecedented equity in their homes. Where years ago they didn't have the equity to borrow against it. Now they certainly do.
So I have a question in the chat from Pete. Pete, you want to ask your question about work from home crowd?
Sure. So basically my question is, what happens when work from home employees are called back and they can't commute from where they ended up? So there was an exodus from New York where people went to Hudson, they went to Litchfield, they went to all these places that were pretty far flung and not necessarily commutable. What happens when they get called back? And then what happens to investors who are buying up houses against the sort of, I think you called them bread and butter buyers, and drove prices up? Does that leave a bubble? Does that break this bubble?
You want to answer first?
They'll default on the loans faster than you can imagine.
Dave, if you have thoughts on it, I'm happy for you to jump in on this one.
Yeah, it's an interesting question.
Agreed.
We haven't seen a huge percentage of folks necessarily going back and called back into work, where I haven't really seen an impact yet. I myself, I live up in Litchfield, so interesting you picked that town. And I have a couple offices I go to, but I do it by need and by having to be visible once in a while, but it's not like it's 5 days a week. So I really haven't seen that impact yet, where folks are panicking that they bought somewhere that was far flung and now they're being forced to come back to the office. We have seen situations where they have two homes. Certainly a lot of New York buyers buy up here in Litchfield County, and they have to work in the city a couple days a week. They stay in their condo or co-op down there, and they come up here on weekends. So I haven't really seen a lot of repercussions yet in terms of that, that where they're going to be forced to come back into work and make decisions. Hasn't happened yet, at least in my experience.
Thinking about Elon Musk's comments to quote unquote the cupcakes who need to come back to work, that might be a wake-up call for a lot of people out there, that this could be a reality. Jamie Dimon's talked about people having to come back to the office. Like that is potentially down the road. A lot of people say the animals are out of the barn, you won't be able to pull people back, but I think over time that may change.
I think the key word is over time. However, I had a young millennial couple, pair of professionals with toddlers, moved out of the city, out to Connecticut, and then they worked for Related, right? A real estate developer in New York. They sold their Connecticut place and moved to Florida. They're not coming back to Connecticut. They're not coming back to New York. I guess it's possible that Related, building skyscrapers in New York, might tell these people, no, you can't work from Florida anymore. But I don't think those people decided to move to Florida strictly over that job. We're still at full employment in America. If Related no longer says we can't have people in Florida and Arizona and everywhere else in the country and lets those people go, I don't see all those people coming back to the New York and Connecticut market. I think that they'll look for other jobs in Florida. They'll look for other jobs in Texas and all the other places.
What will happen, John, what will happen is that those jobs, when they leave those jobs, will be filled by someone who will be at work. So over time, I think this whole Elon Musk's that megaphone is going to filter down. And I think over, it's like I said, we're 85% back. We'll probably get to 95% over time. But I think it's going to be back in person for the majority of people. And there are certainly definitely going to be companies where they embrace that you can work from home. It doesn't matter. And they'll attract those people. But I also think that New Yorkers have all come here to be collaborators. They like being with people. They like meeting people. They like meeting for coffee. They like having their meetings. They like going to the office. It's culture. It's about creating culture. And that's what New York is about. And the people who come to live here love that. Some of the people who left may have gotten sick of it. And I did New York, I'm done. That was going to happen anyway. And we had talked about that COVID kind of just accelerated people's natural decision. They were going to leave anyway at some point, so they just left. But we're going to get filled in with a new crop of people once that crop finishes their jobs and moves on.
I agree with you, Roberto. I agree. I think most of those people who left, they were going to go anyway. They just went a few years early, right? I always premise this with, I lived downtown for many years because I still miss it and loved it, but I happily live on the Upper East Side. I'm raising 2 children in New York City. And, while I spent a number of months out east during the core of the pandemic, I had no intention of ever leaving New York. I'm going to raise my family here. And so I'm one of those people. Right? I'm not going anywhere. And I think that the people who did, they'll be refilled. And I think there's been massive population growth. So we have the bodies, right? There are young people moving into New York every day. I do think your friends at Related will not work at Related, because if we know anything about Related, they are notorious of get back to work, get back to the office. We own real estate. We believe in real estate. So they may be in different roles, but but I agree with everyone. And we haven't seen I haven't seen any indications of that either in terms of, David's comments. I agree with him.
Talk to me about the guy who sells his Connecticut place for $5 million, goes down to Palm Beach and buys for $8 million. Is Wells Fargo, is US Bank consider the overheated Palm Beach market, the Austin, Texas market? Do you guys regard those as risky markets? Those high growth hot spots around the country? Because when I ask these people, why are you going down there? They're like, well, a lot of my financial customers have moved to Palm Beach. They've moved to Florida. And that if that's where my customers are, that's where I'm going. And I said, how do you feel about the prices on the East Coast of Florida? And they're like, yeah, they're a lot higher than we thought they would be. And how about the property taxes? I asked them, and they're like, yeah, 2% of the price of the home I buy. It's a lot of money. So how do you regard, my customers who are selling in Connecticut and buying on the East Coast of Florida, and frankly, Naples, are seeing sticker shock, and they regard it as somewhat risky, but it's something they have to do. That's where the business is. Does Wells Fargo, does US Bank also regard this as risky? And what are they going to do about it? Are you going to stop loaning to those guys? Are you going to just ask them for 2 appraisals? Give me 2 appraisals on that $10 million beachfront.
That's always possible. We have identified certain markets as possibly being overheated, and Florida certainly being one of them. There have not been any drops in loan to values yet, John. I was just with Wells up until about 6 weeks ago, so I don't think there's been any change with Wells Fargo either. But certainly banks are gonna be watching trends, and if they start seeing a reversal or a softening in the market and values start coming down, it would be a natural thing for any or all lenders to possibly start restricting on loan to values or do 2 appraisals.
Yeah. I agree. We haven't seen any movement at this point yet, but clearly our credit risk people are watching markets like South Florida. And, Dave, as a legacy Wells Fargo person, knows, we have what we call market class risk ratings, just like we had that on, that cap in Connecticut at one point in Fairfield County. So we risk rate market class 1 through 4. At the moment, I think the entire country is a market class 1. There's no risk. So we won't necessarily pull back across the board, but if we see data that starts to trend toward, depreciating values or concerns of a drop, we'll move to a market class 2 or a market class 3 as
You
appropriate.
said the whole country is a market class 1, even though Jamie Dimon said there's a hurricane coming?
Well,
And
Jamie
you said
Dimon's
he's a
not
smart guy.
he's not our CEO. He's a smart guy, but he's not the CEO of Wells Fargo. And Charlie Scharf is a very intelligent man, and candidly, I believe a protege of Jamie Dimon's, a former JPM banker. So, and by the way, I mean, we all took a beating, those of us who've been in the mortgage business a long time, during the last cycle in kind of what we call the sand states, right? So for lack of a formal term, but Florida, Nevada, Texas, I mean, these are states where our credit policy people are going to be watching very closely. And candidly, Wells in that way is conservative. We're sometimes first to act. So
why is this not precipitating another like the financial crisis of 08, 09? What's different this time around? Are we just not as highly leveraged?
I think the credit quality is the biggest reason. They're not making loans to folks that clearly can't afford it. I mean, they've learned their lesson. Their underwriting is more, data based. They're looking at trends. If you're lending on your balance sheet, you're doing it with a lot of experience and knowledge, and you're just not going to see the credit erosion. I mean, you may have certain people that are, at risk. One area we've identified at risk right now is folks they're doing new construction or buying an existing home, tearing it down and rebuilding it, and it takes some time. And as inflationary pressure on labor and materials during their construction, their costs are going up, and now they're more leveraged than they thought they would be. But in the values one side of it, the credit quality is probably the bigger side, and we're not. I think as an industry, we're not making loans that would be deemed necessarily ultra risky the way they were 15 years ago.
I'm having a tough time drawing a conclusion on at the end of this hour. I mean, I want to put a bow around this, a nice bow. And what I'm hearing is that the credit quality is good. The whole nation is at, what do you call it, class 1 risk. And yet, smart guy Jamie Dimon says, well, we have a hurricane coming, an economic hurricane. I also hear, 28% of economists are predicting a recession, maybe a mild one next year. So I'm hearing conflicting signals. And of course, you've got guys like Roberto and I in the New York market who are saying, you didn't see the price run up in the New York market and in the Connecticut market that you saw in the sand states. So we don't believe that the same kind of correction that they might be predicting for the nation as a whole is coming to New York. And so I'm seeing different, and the other conclusion you drew was I shouldn't be painting the super rich and the pretty rich with the same brush as the rest of the country. They're behaving differently. They don't have the same affordability problem. How's that for conclusions? Can you both each give me, all three of you, can you give me a conclusion on what I can draw from this hour?
I'll go first. I think, housing prices and the market in general is going to be driven by demographics. Longer term, I'm very bullish because I think, John, to your point, 80 million millennials wanting to buy homes. A lot of baby boomers wanting to relocate still and, hopefully create some inventory as they decide to inevitably pull the trigger. I'm very bullish on the housing market. I think, and particularly in our area because we haven't seen the run up, but I do think we may have some momentary pain just based on how quickly rates and how quickly other commodity prices have risen. You look at the average American, you're going to possibly be paying $6 or $7 a gallon of gas, or go out and go to the grocery store and spend twice as much as they were 2 years ago. I think they have some hesitancy and some concerns. And I think it's more that than necessarily, really being priced out of the market. They just don't know where it's going. And I think the uncertainty is the cause for concern for many people right now. But long term, I'm bullish on the housing market.
I agree that, long term, there's a ton of support, with the housing market. I mean, population growth has far exceeded, building permits, right? So, I mean, you look at companies like Blackstone, who are acquiring, multifamily and single family rentals throughout the nation, because they've recognized that there is demand for these properties. People need a place to live. Very simple. But I do think that, the stimulus that we saw was in excess, and it's easy for me to say that now, but it was, and it went on for too long. And there was too much money pumped into the global economy, and rates were just a little too low. And I think that there has to be some sort of reset or fallout from that. Does that mean that the entire world comes to a crashing halt, or that we experience what we did in 2009? No, I don't think so. I think that to David's point, that the credit quality is much stronger. And then importantly, liquidity is much greater. Homeowners, buyers, consumers, their deposits are significantly higher, their reserves, than they were in 2009. But the fact is, there are mortgages out there, whether it's for mortgages, there is debt out there, whether it's for consumers on mortgages, whether it's corporations, investors. That debt, some of it is short term, it's going to reset. There will be fallout, but that will also create opportunity. And so I think, in short, I do believe in our market. I think you've made some really great points about why we should be more stable than the rest of the nation. The question is how deep and short is that reset, right? Is it 5, 8, 10%? Is it 15 or 20? And is it a 6 or 12 month cycle? But long term, as I said, I'm New York all the way. I'll be here with you now, next year, 5 years, 10 years from now, buying real estate and lending on it too. So,
Roberto, what did you learn? You learn anything?
Stephen, I'll meet you at the bar. I'll meet you at the bar. I got to tell you, this hour, I feel a lot more optimistic. I still had some residual shock, but I feel a lot more optimistic about the market. And I think that, look, I think the demand is there. People want to be here. And it's just a matter of supply and demand finding that affordability level. And it'll find it because people have to move on with their lives. People have to sell and people want to buy. So we'll get there. I think this summer will be, I think there's still going to be a little bit of residual, and the summer will slow as normal. People get acclimated to what's happening, and then come fall, midterm elections aside, because it always puts people into some artificial, stale place. But I think the market's actually in a healthy place because prices have to moderate a bit, and the demand is there. So I think that we have a run of people coming back and us getting from 85 to 95% in the next 3 years. And so I think we're in a great place.
All right, I know you think we're done, but I'm going to have to pin you down on some specifics. It's not enough to say things are fine. So you have been trying to sell a $1.6 to $1.7 million co-op on the West Side recently. Can you tell me that the people who've been looking at that apartment on West 69th, are they affected by the price of that apartment? Have they been affected by the interest rates? Talk to me about the specifics on, are you seeing hesitancy in the market? Did you sell the apartment?
We have offer on the apartment. The maintenance is a little high for some people, and it's just the way it's set up, that it's set up really, people come to see it as a 2-bedroom, and it's really like a glorious 1-bedroom. That's great for someone to work from home, and it's about finding the right person for it. That's all.
It's not, so they're not saying that prices are too high or interest rates are discouraging them. Not a factor. They're just trying to find the right apartment.
Yeah.
Okay. I think that's consistent with what we've heard here today, that interest rates are not affecting our market. People are just being choosy. And it's also not an affordability question, I guess, at that level. The difference between your 3.5% rates that are now at 5.1. Also not affecting, not discouraging that buyer. A little bit.
It's starting to,
Okay. Thank you, gentlemen. Thank you, Stephen. Thank you, David. This was great. We got a lot of content in here. We had a lot of good stuff. So thank you very much. We had 56 people watching it at one point. Thank you, Dejanay. Great question. Thank you, Pete. Another great question. Hope to see you all again next week. And I think next week we're talking to folks on the West Coast, and we're going to find out whether the folks on the West Coast, meaning of America, are as optimistic as Roberto and Stephen and Perry about their market. So tune in next week. I'll see you all then.
See you guys.
Everyone.
Thanks so much.
Thanks,
See you, Skip.
Have a great afternoon, everybody. Thank you.
Thank you, David. Thanks, Stephen.
Thank you.